I'm just going to talk to you in general terms around the Hewison Private Wealth client portfolio investment philosophy. I'm then going to talk about the investment selection process and the process we go through. And then also just talk about the benefits of where we see them to be in relation to professionally managed wealth. Nathan's then going to jump in and he's going to really get into the nitty-gritty and talk about some of the specific examples and the specific asset classes that we look at. Of course, normally cash plays a part, but for the purpose of this evening, it's not entirely relevant. So just in relation to Hewison Private Wealth, and I guess just to give you a little bit of background in relation to what makes us tick, this business has, as I said before, has been in existence for 30 years. It was started by John Hewison. And to its core, the way that this business has been set up in relation to the way that we charge, the way that we invest, and just the way that we manage our client relationships, essentially at its core, the absolute number one priority is our client's best interests. And it's an easy thing to say, but it's backed up by, I guess, the way that we've structured this business. And obviously, in more recent times, there's been legislation introduced around fiduciary duty, how you charge, etc. Well, they're things that have been a part of this business for 30 years. In relation to, if I just sort of start from the beginning, and we'll just sort of step through this, but when we first see a client and they walk through the door, they sit down. Our job is to get to know them on an intimate level, understanding what makes them tick, what are their objectives, short, medium, long term, where are they now and where do they need to be from an income and growth point of view. And we provide what we call objective-based advice, which you may have heard in the marketplace. And I mean, we've got a number of clients in the room tonight that would be aware of how we operate in this fashion. But essentially, we take all the things we get to know about the client, and then it's our job to devise a strategy on a strategic level and an investment level that's going to achieve that particular individual's objectives. The alternative to that in the profession is where obviously time will be taken to get to know the client, but ultimately the client will be asked to fill out a risk questionnaire. That will then determine the type of portfolio that they have to be invested in with that particular advisor. The issue that we have with that is that it may not be relevant or relate specifically to what that person is looking to achieve. So there's a big disconnect there that we just don't agree with. Control and flexibility are absolutely important. They're absolutely paramount. Predominantly, we want our clients to own directly the investments that they're placing their money in, as opposed to purchasing units in a fund type structure. There are some instances that we'll talk about where we see that as being appropriate, but predominantly direct investment for us is where it sits. That enables clients to, as I said, remain flexible, remain nimble, and be able to make investment decisions as they might have a change of circumstances or there is a change in the market. As I talked about from the outset, protecting the downside is absolutely important. And really how we manage investment portfolios is actually driven by an asset allocation. Often getting the asset allocation right is more important than the underlying investments that sit underneath it. And I'll talk a little bit about the importance of asset allocation and rebalancing in a little while. When it comes to selecting the investments that we recommend to our clients, we have the Hewison Investment Committee that sits and meets weekly on a Friday morning, typically for around 2 hours. The investment committee consists of all 6 senior advisors, and it's there that we make decisions on absolutely every investment that relates to our clients, whether that be investments that are being considered to come onto the list. It might be investments that we're reconsidering whether they should remain on the list, or whether there's profit-taking opportunities, whether our research, which I'll touch on in a sec, our research is suggesting that a company might be fully valued and it's time to take profits. And just in relation to the research piece, we're very good at what we do on a day-to-day basis in relation to planning and management, but when it comes to research, we look to outsource that, and we purchase independent research providers such as Morningstar, who are the major provider, and a couple of others that enable us to get a good snapshot of the investment landscape and what's most appropriate for our clients. So again, just a few examples here. We'll discuss, and sometimes a bit of healthy debate will follow in relation to these decisions on Australian company shares, individual mortgage investments, which you may or may not be familiar with. Nathan's going to talk about those in a little while. New property opportunities and corporate actions. For example, Telstra's got a buyback going at the moment, and we need to evaluate that as a committee and then determine whether or not it's worthwhile for our clients to take part in. So just in terms of what we look for, I guess what I'd say in respect to what we look for is investing isn't simple, but it's not meant to be complicated either. Typically, if something starts to look complicated and we struggle to understand what it is or what the objective is, then you start to question where the best interests lie. The first, it's got to pass the smell test, basically. The first thing we look at is can we understand it? And as an extension from that, can our clients understand it? Because we don't act with discretion. We have to seek the approval from our clients. And so therefore it's important, certainly in general terms, that they understand the objective of the investment that we're recommending. It doesn't make sense, as I just talked about. How will it benefit our clients? I mean, as I said before, the main objective is looking at it and saying, okay, well, how is this going to benefit our client in the immediate, medium or long term? And then, of course, we've got to almost do a SWOT analysis of the investment to determine where could this go wrong? What are the, even things that aren't staring at us in the face in the future, what could possibly go wrong that could impact our clients' capital? And just looking at, what are the benefits of having professionally managed wealth? Look, at the end of the day, we are in a position where we do have access to some exclusive opportunities that just aren't available to the retail market. And again, I don't want to steal too much of Nathan's thunder, but he's going to talk in some detail about some of those opportunities. That rational decision making, it may seem simple, but I mean some of the clients that we added significant value to throughout the GFC was actually convincing them not to make emotional decisions. In some instances, and as you can imagine, and there may be some people in this room who, towards the bottom end of that market of the GFC, towards the 2008-9, couldn't take it anymore and just said, we've got to get out. Whereas in this situation, we were really encouraging our clients to consider purchasing some quality assets that had been oversold. And it's that Warren Buffett theory, be fearful when others are greedy and be greedy when others are fearful. Just in relation to this disciplined approach to portfolio rebalancing, as I mentioned earlier, we set an asset allocation across the major asset classes for our clients, and every single client of Hewison's is treated differently and independently according to what their individual objectives are. Some people might argue it's an inefficient way of managing, but that's how we see that is most appropriate for high net worth individuals. So what are your objectives? Okay, we're going to put together an asset allocation, certain percentages going across the board there, and then it's our job to continue to rebalance that over the journey. So to give you an example, we might have a year where shares do quite well. They might outperform by 10%. We would expect fixed interest to remain pretty stable. Maybe property has fallen 5%. If we evaluate that versus the target asset allocation, we're going to see that some changes need to be made. We might look to take some profits where the Australian equities have done well and reinvest into those asset classes that haven't, or either stayed stagnant or maybe haven't done so well. And by virtue of that process, what we're essentially doing is taking profits from the top, taking a bit of cream off the top, and reinvesting into quality assets that may have suffered a bit of a downturn. So without timing the markets, we're still getting the same effect of selling high and buying low.
I'm going to kick it off by talking about the property sector and in particular our philosophy. So firstly, as Andrew mentioned from the outset, our preference is to invest in property directly wherever possible. So this might involve a client purchasing a physical property, whether it's a residential house in a blue chip suburb of Melbourne or a factory in the suburbs, They may do this on their own accord, or they may work with a buyer's advocate to do that. So it really depends on the client's objectives whether they'll do this. Now, property is a lumpy asset. Generally speaking, you need hundreds of thousands of dollars to purchase a good quality property. So it's not always possible to buy a direct property. So that's where sometimes you may need to use a syndication or more of a managed style approach to buy property. So what we like to do in the property space is partner with a couple of high quality property managers who can provide us with investment opportunities in this space. We've got strong relationships with a couple of managers. I'm going to go through a couple of examples in a moment. Now, many of these investment opportunities into the property that I'm going to talk about tonight are not mainstream. So they're not necessarily available to anybody. So having these relationships that our firm has built over our 30 years plus of existence is extremely important. In addition, many of these opportunities are wholesale investments. So in order to qualify or be able to invest, you do need to meet the significant investor definition. For accountants in the room, you probably know what that means, and some of our, probably most of the clients in the room would hopefully meet that definition. So in terms of the next point, the structuring, now this is extremely important. Throughout the GFC, many people learnt lessons in terms of getting the structuring right. In particular, many open-ended managed funds got themselves into a lot of trouble, high levels of gearing. If there's a little bit of a correction in the market, basically they can get caught with their pants down, and a lot of them did go belly up. We had a lot of clients come to us who had lost a lot of money in property. Now, the underlying value of the properties has not necessarily fallen apart. It's more the structuring issue. So after the GFC, we spent a lot of time tightening the screws on how we do property. We've very much got a single asset preference. So generally speaking, it'll be one asset that'll be in the syndication. It can be more than one, and we're not adverse to being more than one, but we find that if there's too many properties, that's where things can start to go wrong. Closed-end structure is quite important. With a lot of open-ended structures, the manager may buy a property, they might buy a couple of properties to start. As more investors catch on and want to invest in these funds, basically the manager will have cash and they'll just start buying more properties. Now, this can lead to a situation where they may potentially just buy properties for the sake of it. They've got the cash, or they might overpay for property. So with a closed-end structure, we have much more control over it. Capital is raised, they'll buy a property, and then they'll hold the property for the term of the investment, which may be anywhere from 5 to 7 years. A lot easier to control for the end investor. So moving on to our investment committee. Look, I won't speak about this for too long because Andrew touched on it. When assessing property opportunities, I'm going to go through a few examples. We meet with the managers several times as a minimum. In a couple of situations, we'll actually go out to the property and do a site visit. And the last point is just around diversification. So when constructing a portfolio of property assets, we really do want to spread it around different parts of the property market. So, for example, if $1 million was going into a residential property, that's one asset exposed to one part of the property market. Ideally, we might like to put 4 lots of $250,000 into different style property. So whether it's an industrial property, a commercial property, a residential property, just to try and spread that risk around, because we do know in Australia at the moment, different parts of the property market do move in different, they're not perfectly correlated, they move in different directions. We've seen residential obviously quite strong, and other parts, commercial, several years ago throughout the GFC didn't do so well. So it is important to diversify in that regard. So the first example that before I get into the examples, just in terms of what we look for in property, it's, as Andrew said, we're not going to try and overcomplicate it. We want quality property assets paying good income and with growth potential. So obviously location, anyone that owns a property, a location's probably one of the first boxes you want to tick. You want to make sure it's in a good location. A high quality tenant, we want to make sure they can pay the rent effectively, that they're not going to go bankrupt. The quality of the income is really underpinned by the lease. Now, generally, longer lease terms are desirable, but not always. There's I guess, the situations where a shorter term lease may be the case. Conservative gearing, as I said, that's where things can go wrong if the gearing levels are too high. So generally around the 50% mark is no more than that really. Value add potential, I'm going to talk about a couple of examples where value add can really help the performance and returns on property investment. So I'll come to that in a moment. And just understanding the property and its nuances, and I'll talk about a few examples that will help demonstrate that. So the first example that I'd like to talk to you about is a property that everybody hopefully has realised, because it's the building that we're in right now. 417 St Kilda Road. There's a seat here if you'd like. Seat at the front there if you'd like. So 417 St Kilda Road. Now this property was bought to us by Newmark Capital, who are a specialist property management group. They purchased this property in 2012 from Challenger. Now Challenger, you may know, they're mainly an annuity business. So when this property was purchased and owned by Challenger, it was managed in a very lazy way. They didn't really put enough attention into the leases, getting good quality tenants in there. Also capital works, because income was their focus, they weren't really prepared to spend a bit of money on the property to try and improve it. There was also a situation with Oracle, who is the anchor tenant. When it was purchased, the lease, Oracle's lease had about a year and a bit to go, and there was some uncertainty around, whether Oracle would re-sign. So Newmark, through their analysis, demonstrated to us that there was a high probability that Oracle would actually remain in this property for a couple of reasons, and the main reason being this building has generators, which is very important for Oracle being a global software business. They need to stay online 24/7 basically. So that was a key reason. Also the car parks, there's 472 car spaces here, which was a very important factor for Oracle as well. So I'm going to just flick to the next slide, which shows a few of the key metrics. Just the major tenants about halfway down: Oracle, Red Cross and Fleur, who are a global engineering business. Now it was purchased for $81 million in late 2012. That's just been revalued at $121 million as of June this year. So obviously that's a handsome increase in capital. Now a couple of key drivers around that performance. It's obviously the quality of the leases. They've renegotiated leases, but also the capital improvement they've undertaken on this business. Now, some of our clients, I know some of you here are invested in this building, you may know that they did a lot of work down the bottom. So there was a bank and not a lot else down the bottom, complete renovations. There's a whole lot of cafes, eateries. It's a lot nicer. They've renegotiated new leases. They've fixed up the car park out the back, more revenue out of the car park. So a lot of this value is therefore being reflected in the valuation. So it's paying 9.2 cents per unit. So for investors that went into it, they're getting 9.2% per annum, and plus there's been about a 60% increase in valuation. So it's been a very attractive proposition for our clients. The average weighted lease expiry has been pushed out to around 4 years due to Oracle re-signing and a few other leases such as us. And the gearing is a comfortable 45% as well. So another example in the property space I want to talk to you about is 269 Centre Road in Bentley. So throughout the GFC, we did have a lot of trouble finding good quality property because the listed space, listed property trusts were extremely volatile, falling 70% from high to low. And there was a lot of managed funds out there, pooled managed funds with dozens of properties that didn't really fit within our preferences in terms of single asset and closed-end structures. So what we did was negotiated an Australian Securities Limited, who is a firm we've had an association with for 20 plus years, who help us with our secured first mortgage investment, which I'll talk to you about in a moment. We created a vehicle with them where our clients could invest in single asset direct property. So we've since completed about 6 of these with Australian Securities Limited, and this is one of the examples. Now they put forward opportunities to us as they as they come across them, and our investment committee once again scrutinises them and will only add them to our approved product list if we're extremely comfortable with them. So this property in particular, it's an office building, not too dissimilar to some of the issues with Newmark. It wasn't being managed effectively. There was vacancy in the building, so the rent wasn't where it should be. And that was somewhat reflected in the valuation. So they purchased it for $5.55 million in April 2014. Since that time, they've spent a lot of work on the building, in particular, not only on the inside, on the outside, making it look a lot more appealing, and renegotiated a lot of leases, got some new tenants in. So that's not only been reflected in the valuation, which you can see has increased some 30%. In quite a short period of time, only just over 2 years. So it's now worth $7.3 million. And the net rental return is now 6% per annum. It wasn't that high from day one. Our clients understood that. We understood that. It was more of a growth profile investment. So I think in the early years, it was generating around 4% income. But we understood, be patient, get the tenants in, renegotiate the leases, and we'll see the value. So the average weighted lease expiry, 3.2 years, comfortable with that. It's been pushed out. A very conservative gearing at 20% and a 7-year time frame. This is just a photo of before and after. So you can see before, basically, not much work had been done. The plants at the front were overgrowing. So that it just shows some of the work they do just to make the property a lot more appealing, not only on the outside, but on the inside too. Okay, so the next example I want to talk you through is the Shakespeare Caims Oasis Trust. So Shakespeare, the manager, they're a Melbourne-based property group. Now, they were initially set up to manage their own family's wealth, a wealthy family with origins from Malaysia. So they came to us, aware of our firm, because they wanted to partner with a couple of boutique wealth management firms to help them to acquire good quality properties. So this recent acquisition, I'll just flick to the next slide, is a hotel. Obviously, it's the Novotel Caims Oasis Resort. So they purchased this property for $48 million. Basically, it's just going through settlement now. Now, one of the main attractions with Shakespeare, which we really liked, was they actually owned the Pullman, which is 600 metres or so up the road. So they know the industry, or they know the market. They'd undertaken a lot of work in terms of the tourism industry. So Cairns being at the doorstep of really the Daintree rainforest and the Great Barrier Reef, a lot of tourists, in particular from the Asian market, China. This is where they'll fly into. They'll want to spend time seeing those great Australian attractions, and then they'll make their way to Ayers Rock or Sydney and other famous parts of Australia. So they'd undertaken a lot of due diligence on this market and on the growing number of tourists. They've done considerable stress testing, and they understand that even in the worst cycle for tourism, that's not going to have too much of a significant impact on the income. The annual rental income will be 8.5% per annum, which obviously is quite attractive. Even if vacancies are around 50%, that income would only fall to some 4.5%. So even in the worst possible period, it'll still pay quite attractive income. Gearing's 55%, which we're comfortable with, and it's a 4 to 7 year term. Just want to now jump over to fixed interest. So fixed interest obviously is a different sector to invest your money. Once again, we've got a direct focus. We'll avoid managed funds as much as we possible. We want our clients to have that control and flexibility, as Andrew spoke about. Why is fixed interest in your portfolio? For the income. A reliable, predictable, reliable income stream is why we invest in fixed interest. It's also very important for a couple of other reasons, but in particular to protect the downside and also lower the levels of volatility. So, for example, if you had a portfolio, which you probably never would, full of equities, it can be very volatile. having fixed interest helps smooth out the returns. Although the growth potential might not be quite as high as other asset classes, it's really the predictable, reliable income why we want to go into this sector. The ability to rebalance is very important for fixed interest. Andrew did speak about this. I won't really touch on it in too much detail. But if the Australian equity sector, for example, does fall in value and we want to go in, we want to buy when it's low, this is the part of the portfolio where we'll use. So it is important that there is liquidity in this part of the portfolio, and I'm going to talk to you about how we achieve that. And just diversification. Obviously, there is different types of fixed interest investments from whether it's a term deposit, a mortgage investment I'm going to talk about, or a bond. It is important to blend your fixed interest exposure across the different fixed interest instruments. So I'm going to talk to you, to kick it off in the fixed interest sector, I'm going to talk about secured first mortgages. So clients of ours would probably know these quite well. In our experience, they're not that well known. So if we have a new client come to us and we talk about this, often they're a little bit taken aback. Oh, what's a mortgage? Is it a mortgage fund? Is it pooled? Is high risk? Subprime crisis? That's all what that stuff was. So once we explain to our clients that what it is and how we do it, we find they're a lot more comfortable. So firstly, they're individual mortgage opportunities. So they're not pooled. That's probably one of the key things I wanted to mention. We have a relationship with 4 providers who source these opportunities to us, and each specific mortgage is put to our committee. I'm going to show you an example in a moment, which we'll either approve or reject for our clients. If we allocate a large chunk of money towards fixed interest, let's say it's $1 million, or for mortgage investments, we're not going to put $1 million into one particular mortgage investment because we really want to spread the risk. So they might get 10 or 15 different mortgage investments with different interest rates, different maturities, different levels of risk. I just want to quickly explain what it is in case people don't quite know how they operate. Really, it's non-bank lending. So secured first mortgages is non-bank lending. So if you want finance, you probably go to a bank. That's what most people will do. But there's a lot of people out there that don't want to use the normal banking channels for various reasons. This might be to bad credit history. This might be to the fact that they want to move quickly. They're business owners. So this is a big part of the market. In particular in Australia with the banking industry, the screws are being tightened with calls for a Royal Commission, a perceived property bubble. Banks are a lot more cautious. So that is forcing a lot of other people that need finance to look for, non-traditional channels. So in this situation, the client or our investors or the clients are the bank. They're lending money to borrowers, and in return for that, they're receiving a fixed rate of income. Now, that income in the current environment, Australia, record low interest rates, cash rate of 1.5%, probably lucky to get 2 or 3% on a term deposit. Our clients can achieve around 5.5% to up to maybe 7.5% on these mortgage opportunities. We consider these low risk. I'm going to show you an example in a moment. As long as you understand the risk, you can see why we think they're extremely attractive investment propositions. In terms of the loan to value ratio, the last point, we're quite conservative by nature. So we will never take on loans for our clients if the loan to value ratio is greater than 66%. So the underlying property which acts as security, let's say it's $1 million property, the provider that we use will never lend to the borrower more than $666,000. So in order for our clients to have any risk of losing capital at the extreme, at the highest LVR, some are much lower, that property would need to fall by 34% to even lose 1 cent of capital. So not saying would never happen, but in our view, it's low probability. So an excellent track record for 20 plus years. This is an example of what we look at. This is a residential mortgage example, a blue chip type suburb of Melbourne in Toorak, 60% loan to value ratio. This is a live example that we approved some 2 months ago, I believe. Paying 6.05% per annum variable with a 2-year term. So we obviously see a lot more information. We see a valuation, but this is the type of mortgage our clients are investors in. So just still on fixed interest, moving across to corporate bonds. Now, traditionally, corporate bonds have been out of reach to many investors because you do need a minimum investment amount of $500,000. So unless you're ultra high net worth, you're probably not going to invest in corporate bonds. So bonds, just in terms of what they are, people probably know what bonds are. Heard of bonds as government bonds, which are the absolute safest, but then corporate bonds are a little bit down the risk curve. Big Australian corporates, whether it's Telstra, Woolworths, BHP, will issue funds, raise capital via corporate bonds where our investors will lend them money and they'll pay them a fixed rate of income return. Corporate bonds are, generally they're perceived to be quite safe, but they are a little bit more complex because they can. There is an inverse relationship between the income that they're paying and the price. They can fluctuate in price, but the important thing to note, if you do hold a bond to its maturity, you will get its face value. So if its face value is $100, you own that bond, you'll get your coupon payment, and when it matures, you'll get your $100 back. So in the meantime, over its life, it could fluctuate, but as long as you hold it to the end, you'll get your capital back. Another attraction of corporate bonds, although they do pay slightly less income than other debt instruments, such as the mortgages I just talked about, or hybrid securities, they pay less income, but they are much higher up the debt structure. So, in the event of liquidation of corporations, this capital would be repaid first. One of the reasons why we wanted to try and incorporate bonds into our portfolio, I'll show you in a moment how we actually do that, is the negative correlation to equities. So throughout history, if you look back, generally speaking, equities and bonds will not really move in the same direction. I mean, maybe in some unique situations they can. So generally, if equities are not performing well, bonds are going well, and vice versa. So this is important as a tool for us to rebalance our clients' portfolios. If equities aren't going so well and we want to get our hands on some fixed interest, it will most likely come from this part of the portfolio. So how do we access bonds? The Australian Bond Corporation, as I spoke about earlier, if you want to go direct into a bond, you need $500,000. So Australian Bond Corporation have pioneered an initiative where these exchange-traded bonds are listed on the share market. So it's like buying a share. So they've got a code and you can buy as much or as little as you want in these corporate bonds over major Australian corporations such as a Telstra or a BHP and many others. So what we'll do for our clients is blend a portfolio of around 5 bonds with in different companies with varying maturities and varying interest rates to try and manage the risk. We've got several criteria that we look at. For example, a minimum BBB credit rating. History or analysis has showed us that it's quite rare for a corporation with a credit rating of BBB or above to actually default on their bond repayments. So we're quite comfortable with that regard. And just in terms of rebalancing a portfolio, having the ability to access bonds, in the past, a lot of our clients have had the mortgage investments which may be locked away for a term, and hybrid securities, which clients of ours may know are listed fixed interest instruments which have a combination of debt or equity. Now they can, in a down market, they can actually come down with shares. So having bonds in the portfolio negatively correlated to equities was quite important. So if we do need to make quick decisions with the portfolio, want to buy some shares, it's most likely going to come. It's going to come from this part of the portfolio. I'm not going to talk too much about Australian equity because most people in the room probably know shares quite well. Andrew is going to touch on international shares. So just in terms of Australian shares, what we look for, we focus on quality, mainly with an ASX top 100 focus. So we don't really want to look too deep. We just want to focus on the top end of town good quality blue chip shares with a long track record of delivering good performance with paying good dividends or income. We look for industry leaders and we look for diversification across the sectors. So what I mean by that is different parts of the economy will not always move in the same direction. So we might want healthcare, resources, banking. We really want a good mix of the sectors because as we've seen over the last few years, for example, resources have come off, but healthcare, for example, has picked up the slack. So it is important to have a good mix of companies across different sectors. Just independent research. We do subscribe to independent research from Morningstar, which help us formulate our the stocks that make it onto our approved product list. Our investment committee then has strict criteria which we overlay on top of that. Long-term focus. When we buy a company, we want to hold it. Generally speaking, we want to hold it forever. We want to buy good quality stock and hold it forever. We'll be quite active around making adjustments to that holding. So if a stock does really well, clients of ours will know that we'll probably look to take profits. If a good quality stock underperforms for in the short term for whatever reason, that could be an opportunity to go in there and actually top it up and buy more. So to Andrew's point about rebalancing, we do have a strict philosophy and that will generally help us with our buy low, sell high approach.
In relation to international investment, look, the objective is pretty simple. It pretty much mirrors what we look to do in the domestic space, and that's to gain exposure to best of breed, industry leader type businesses that are offering value from around the world. So we're looking for companies that have a strong track record, good management, strong record in relation to profitability, cash flow, that are offering value, so they're undervalued. Of course, the historical challenge has always been gaining trusted research because the Aussie economy makes up 3% of the global economy. So, 97% of the world out there, and there's so many companies out there gaining and looking for trusted and reliable research has always been a bit of a challenge for us and for many investment managers, I would suggest, in Australia. Our traditional approach as a way of getting around that has been, in this instance, to use a managed fund provider. It's never been 100% ideal, but at the end of the day, they do have the resources and the legs on the ground to be able to do that research on a global scale. We use absolute return fund managers, and by that, what that generally means is that they're not managing to an index. So they're out there doing their research on the companies that they feel are best positioned to outperform the index. And a couple of examples that we've used, and there might be some familiar names here, but the Platinum International Fund and the Magellan Global Fund, they're managed by two doyens of the investment industry, Kerr Nielsen and Hamish Douglas. One of the things, aside from how well known they are and their long-term success, one of the things we like about both of them is they've both generated their own personal wealth by having money in each of these investments. So they've got skin in the game. Just bring it forward to today's methodology, and I know there'll probably be a couple of current clients which will want to talk about this in some detail because some of these changes are quite new. We're looking for a more diversified approach, and we have been looking for some time to, again, try to increase the level of direct investment in that international sector for quite some time. We're still using absolute return fund managers because at the end of the day, if they're doing a good job, they deserve a seat at the table. But after a number of years now of researching providers of good research, we're now very comfortable. Morningstar actually now provide international research. We've been tracking that for a couple of years now, and we're now very comfortable with the quality of the research that they provide in the international space. And I should say that as part of that 2 to 3 year process, we've conducted 2 site visits to Morningstar's offices in Chicago and New York to sit down with the analysts and get a better understanding of of how they research companies in the international space. And we've been running a test portfolio over the last 18 months, which has proved to be very successful. And it's a combination of Morningstar's international model portfolios. They call them a tortoise and a hare portfolio, essentially a growth and income portfolio. We've got, again, as Nathan talked about domestically, we've got our own parameters that we overlay to create a more refined investment list. And this is something that's very new to us, is the inclusion of a private equity fund manager, which I'll talk about in some detail in a moment. These are just a few examples. They don't all sit on the list at the moment, but these are a few of examples of the companies that our clients can now own directly. These are global success stories over a long period of time, and it's really quite exciting for us to be able to offer these direct exposures to our clients. So I talked before. I mentioned private equity. I mean, I have to say that we weren't looking for private equity. To be perfectly honest, I think that the private equity space, if you don't really understand it, has some perceived risks to it. But it was really interesting that dealing with Partners Group, who now sit on our recommended list over the last 2 years, they came knocking on our door 2 years ago wanting to talk about it. We were very, very hesitant to begin with because, I mean, our perception, much like some other people, might have been that private equity has got that high risk. It might be more speculative, startup type phase businesses, whereas Partners Group are quite the opposite. And I must admit, they've really won us over in our discussions to convince us that in many respects private equity has lower volatility, and in many respects is actually lower risk than the listed counterparts. And if I use the property example between an unlisted property and an LPT, during certain market events, which may cause investors in the listed space to make irrational decisions, as you know, that I talked about earlier tonight, which of course impacts the value of the listed property. There may not be anything wrong with the property. It might still have great tenants, great lease terms, all those qualities that Nathan talked about, but they're being impacted by investors making irrational decisions and their ability to buy and sell on the market instantaneously. Whereas in that unlisted space, and in this case, you know, it's business as usual for these unlisted companies. And many of these companies that are unlisted are of the same size as their listed counterparts. So just in terms of how Partners Group operate in this space, for them, diversification is absolute key. They're not going to put all their eggs in a few baskets, because obviously if one of them isn't successful, then that can really have an impact on performance. So they really look for a diversified approach. Upwards of 1,500 companies they invest in. I mean, they're a global manager, managing billions of dollars around the world with an Australian subsidiary fund, which is offered to Australian investors. They will either take direct ownership in a company, or they will take a fund of funds approach, which means they might go and buy a basket of other unlisted businesses. No startups, only profitable businesses. They will vary in their life cycle, whether or not they're still in a building phase, or whether or not they're at more maturity, at a more mature phase. But they look to extract value by working with the existing management that's in place to grow the profits, not then just to try and sell it on a higher multiple. So they really are about investing in the business and seeing that business grow. And with the companies that they have a direct ownership in, they prefer to take a board position. I mean, they've got a huge amount of experience from global markets around the world, and if they can take, an existing intelligence that they have in a particular industry and flow that into a company that they've taken ownership in, then of course that's going to benefit the business, much like the Warren Buffett, Berkshire Hathaway type of example. This graph is really interesting. Just before I even go into this graph, when we talk about the volatility, to give you an example, in the listed space, globally speaking, throughout the GFC, that the top to bottom fall from an index point of view was north of 50%, whereas in the Partners Group example, the top to bottom fall was around about 12%. Because, as I said, for many companies, fundamentally, nothing changed. It was business as usual, but they just weren't being oversold on the market. This just is a performance graph which just shows that over 16 years, this particular investment structure has outperformed the MSCI World Index by 7.9% per annum, and has outperformed the general private equity space by 3.8%. So it gives us a lot of comfort when over a 16-year period they've been getting. And when I talk about the returns of a group like this, we're not talking about 20, 25%, because if you are getting those types of returns, you're either really, really good at what you're doing or you're taking risks. And these people are not about taking risks. Their average performance annually is around about 10 to 12%. So, ladies and gentlemen, it's obviously we've gone for a fair amount of time here, and I appreciate your attention. Just in conclusion, there's some of the things we talked about tonight. We talked about the Hewison philosophy, investing in the best interest of the client, ensuring that our clients remain in control of the asset through direct ownership predominantly. Protecting the downside is absolutely paramount. We talked about the investment committee and the processes that we go through, meeting weekly, debating these investments. Can we and our clients understand these types of investments? And I didn't mention this earlier, but I mean, we actually reject the majority of the things that we see because they just don't pass the smell test. We also talked about the importance of professionally managed assets, access, rational decision making versus emotional, and that disciplined rebalance approach. Nathan then came on and just gave some really great examples in relation to investing for high net worth individuals from each of these asset classes, property, transparent investment structures, value add opportunities, fixed interest, direct focus, predictable income, Australian equities, again, direct focus on the quality, and then in that international space, again, quality diversified exposure via managers and now direct investment.